Welcome back. Now, after nearly 2 months of range-bound trade within 1% of all-time highs, U.S. markets finally saw some volatility ahead of the key Federal Reserve meeting on interest rate policy scheduled for September 21. With more on market action in the States is Jill Malandrino, VOA Channels TV business correspondent in New York City. Hello, Jill. Good morning. I wanted to say good afternoon right away, but then I know it's morning, your own time. Good morning, Jill. Now, is the volatility here to stay, considering September is historically volatile for the S&P 500?
And good afternoon to you. That's a great question because the action from last Friday really threw traders off guard. So let's examine what's happened since then. For 44 trading sessions leading up until last Friday's sell-off, the S&P 500 was trading in super tight ranges, with dips being immediately met with buying. Then a few Fed speakers came out Friday at 10 a.m. Eastern, and the selling was fast and furious. Now, the media was blaming the sell-off, which took the major averages down over 2%, but it was not just on interest rates alone. 25 basis points is a drop in the bucket when you consider we've been in a historically low interest rate environment for nearly a decade. The bigger concern are the bubbles being created across multiple asset classes, with central banks artificially propping up the markets. So what happens when that starts to unravel?
So was the Fed testing the market to see if the same reaction would take place like it did at the end of 2015 through February 2016 following the last interest rate hike?
One thing you have to give the Fed is they've been very clear with telegraphing its intentions and the fact it remains data dependent. Now, one of the reasons that the Fed normally hikes interest rates is to cool off inflation, which has not been a problem for years, and there are not many signs that it will become a problem. On the other hand, some economic data has been strong and some has been weak. So again, we're seeing mixed signals. I spoke with a trader who also contributes to Forbes magazine, and he told me this: if the Fed wants to raise rates, great, go ahead, raise them. If not, don't. But don't tell us that you're going to raise rates at every meeting, then when push comes to shove, you back off for whatever reason and blink away. If you must broadcast a message between meetings, keep your people on point and don't send the market mixed signals.
Now, based on market action yesterday with the S&P and Dow up almost 1%, it seems as if the hike fears have calmed down a bit.
That's what makes this week's trade so interesting, because for the first time since the beginning of July, we saw volatility back in the market. Down one day, up the other, and so forth. Data showed retail sales and industrial activity fell more than expected in August. Other reports showed a slowdown in job growth and a slump in manufacturing activity for the month, and that further eased expectations for the Federal Reserve to raise rates at its meeting next week. Most likely, we will not see a hike until after the national election at this point. The Fed is in its quiet period until the meeting, so there will not be mixed dovish and hawkish messages from speakers until then.
Now let's look at the Nasdaq, which was up almost 1.5%. There certainly is a stock-specific story there, isn't it?
There definitely is. Apple was absolutely on fire this week, seeing its best four-day run since 2014. On news, the first quantities of its iPhone 7 Plus were sold out globally. With Apple having surged 11% over the past 4 trading sessions, its suppliers also rallied. And those are NASDAQ-listed stocks, which is why we saw the relative outperformance in that index. In fact, going to trade today, the NASDAQ is within 33 points of its all-time high on September 7th.
Right, thank you so much for your time, Jill. We will keep our eyes on the ground to see what Fed will put on the table next week. Enjoy your weekend, Jill. And of course, back here in Nigeria, let's quickly take a look at the FMDQ fixed income market. I'm being joined by fixed income dealer with GT Bank, Chioma Udu. Good afternoon, Chioma.
Good afternoon.
Now, it's the final trading day for the week, and of course, looking ahead of the MPC meeting, what is the sentiment like today?
Okay, we've seen a very, very active market today, sideways trading with bullish buyers. We've seen a lot of people trying to get out of your position in view of the MPC, so they don't have any sticky assets after any decision is taken at the MPC.
We just got the inflation figure coming in today, August inflation figure at 17.6%. How's the market reacting to that figure?
17.6 wasn't as bullish as it used to be from the other month. So it really hasn't affected the trade in the market. We've seen a lot of traders going to buy at the long end of the curve. Like I said earlier, a lot of people trying to get out of their position in view of the MPC coming next week.
So what's your expectations for the markets next week?
Our expectation next week, the first 2 days in the market, we're going to see quiet trading in anticipation of the results from MPC, with a bullish bias on the short end of the curve, really.
All right, thank you very much, Chioma Udu there from GT Bank. We also cross over to the FMDQ Forex market to see how the currency is trading today. And I'm being joined by an FX dealer with Access Bank, Ifweko Olotu. Good afternoon, Ifweko.
Good afternoon.
So what are we seeing today with the Naira-dollar trade?
I think so far we've been able to see some stability with regard to the rates. Currently, we've had closing rates at about 306, 308 levels. Even today, we haven't really had any trades higher than 315. So I think CBN has been able to achieve stability with regards to rates in our market.
Now,
well, of course, this is different from the story in the parallel market.
The dealers there, I mean, you dealers, how are you people expected or looking forward to the meeting, the MPC meeting next week?
Honestly, I'm not expecting the CBN to carry out any new policies with regards to FX.
So what is your... Okay.
Yeah, we're not expecting any changes with regards to FX. I think to a large extent, the CBN has been able to roll out quite a number of policies to stabilize the market, which we are currently experiencing.
Okay. Today is the last trading day for the currency. What is your outlook like for next week? What are your expectations?
Next week, we aren't expecting any significant changes. Hopefully, yes, the rates remain where they are and no skyrocketing of volatility. So currently, from this point of view, from the market point of view, from this past week, we're just expecting that rates will be maintained within the 305, 315 band.
All right, thank you very much, Ifweko Olotu, for your time. Ifweko Olotu, FX dealer from Access Bank. And we'll move on now to Zimbabwe, where the central bank says it will introduce local bank notes known as bond notes at the end of October, raising fears of a return to a domestic currency abandoned in 2009 due to hyperinflation. Zimbabwe is in the throes of its worst financial crisis since it switched its currency for the US dollar, and the new notes are meant to help address cash shortages that have fueled protests against the government. Reserve Bank of Zimbabwe governor said during a monetary policy statement the equivalent of $75 million in the notes will be circulated by year-end, adding the bank was very far from reintroducing a local currency. But activist leaders say the scheme would not answer their concerns and promised more rallies against economic hardship.